In 2000s, investors are looking for low-risk HR investments, so they went into U.S. housing market with the intention to get more return on interest rate paid by owners on mortgages than treasury bond, but they do not want to buy an individual mortgage because it will hassle. Instead, they bought investments called mortgage-backed securities. Mortgage-backed securities is a type of asset-backed security which is secured by a mortgage or collection of mortgages. The mortgages are aggregated and sold to a group of individuals, a government agency or investment bank, that securitizes, or packages, the loans together into a security that investors can buy. Investors like to do this because it will produce a higher return than other investments. Next, it appeared to be a safe bet because credit rating agencies had previously told investors that mortgage-backed securities were safe investments, and they gave most of them AAA ratings. This is because mortgages were only available to borrowers with good credit. Furthermore, the increased demand for mortgage-backed securities can cause house prices to rise, and in the worst-case scenario, a defaulted borrower can sell their home for more money. As a result of this benefit, investors want more of this security, so lenders and banks did their best to create more, but to create more, they needed more mortgages, so they loosened their standards and approved loans to people with even bad credit ratings, subprime mortgages. Because of this, house prices were going up, and people were unable to pay mortgages. As a result, more houses are for sale as house supply increases, demand decreases, prices collapse, and people pay for houses that are worth less than they paid for. Collateralized debt obligations, CDO, are financial products created by bundling various debt securities, such as mortgages or corporate bonds, into a single package. Furthermore, investors will buy the CDO according to their risk appetite. Moreover, CDO is divided into three tranches, which are junior, mezzanine, and senior. Seniors have low risk and low return, while juniors have the highest risk and high return among the three CDO. In addition, if the CDO was defaulted, senior can claim the collateral first, mezzanine second, and junior is last to claim the collateral.
Dive into the world of finance and explore the intriguing concept of credit default swaps, or CDS. This derivative instrument involving a buyer, a seller, and a reference entity offers protection against default and other risks. Understanding the mechanisms of a CDS is the first step to grasping its implications on the global economy. How is a credit default swap used in the financial world? Primarily, it's a risk management tool, helping entities mitigate credit risks tied to loans or bonds. Additionally, it becomes a speculative tool during financial crises. Whether for risk management or speculation, CDS play a vital role in financial markets. Let's take a closer look at how credit default swaps operated during the global financial crisis. It all started with origination, led to an agreement, then periodic premiums, and finally defaults. The impact of CDS during the GFC is an important piece of modern financial history. What role did credit default swaps play in the 2008 global financial crisis? They amplified it through speculative practices and increased volatility, concealed risks due to their complexity, and triggered a domino effect of losses due to financial institutions' interconnectedness. The 2008 crisis showed us the potential dangers of CDS, highlighting the importance of understanding these complex financial instruments. The world of credit default swaps is vast and complex. Dive deeper into the topic of CDS and enhance your understanding of its role in the global financial landscape.
The American financial system is rocked to its foundation as top Wall Street institutions topple under a mountain of debt.
I wake up every single night thinking, what could I have done differently? This is a pain that will stay with me for the rest of my life.
Lehman Brothers, one of the largest investment banks in the United States, faced a severe liquidity crisis due to significant losses from its heavy exposure to mortgage-backed securities and risky real estate investments. On September 15, 2008, Lehman Brothers filed for bankruptcy protection, marking one of the largest bankruptcies in U.S. history. The failure of Lehman Brothers significantly contributed to the severity of the crisis and prompted government interventions and regulatory reforms aimed at stabilizing financial markets and preventing future systemic risks. Financial institutions collapsed due to the subprime mortgage crisis, stemming from reckless lending practices creating a housing bubble. Banks offered risky mortgages to high-risk borrowers, leading to defaults and market crash. Excessive risk-taking compounded the crisis, as institutions leveraged investments with borrowed funds and complex instruments like credit default swaps, CDS. Rising defaults devalued these instruments, shattering investor confidence and triggering a market panic. Interbank lending froze amid uncertainty, intensifying the liquidity crunch. This interconnected web of irresponsible lending, risky investments, panic selling, and frozen credit markets caused a catastrophic collapse in financial institutions, culminating in a global financial crisis. This crisis highlighted the need for transparency, responsible implementation of financial tools, and robust regulations to safeguard against similar catastrophes, emphasizing the importance of managing risks effectively to prevent widespread economic harm.